Good afternoon, everyone. This is Patrick Somerville, Senior Partner and Head of Business Development here at Hamilton ETFs. Thanks for joining us today. This is our fifth national webcast with prominent Wall Street strategist Ed Yardeni, so we're grateful to have him on board today. The agenda for today will be as follows. We're going to do a quick, brief update on Hamilton ETFs and also a short overview of two timely investment ideas. Then I'll hand things over to Rob Wessel, our co-founder and managing partner, who's going to lead the Q&A with our distinguished guest, who's here to share his thoughts on the U.S. economy and stock market. So very quickly, this has been a really exciting last couple of years here at Hamilton ETFs, and we continue to be one of the fastest growing ETF providers. Our current AUM stands at 4.7 billion, recently surpassing 3 billion just this past November, which was actually around the last time we did a webcast with Ed. So Ed seems to be a bit of a good luck charm with us. I should also point out that we were proudly recognized with a nomination from Wealth Professional recently as with the nomination as ETF Provider of the Year in the category for 2023. So we will see if we will take that award home, but we're proud to be nominated amongst some other very good providers. So I think most of the people on the line are pretty familiar with us, but in case you're not, I'll just shortly share our three categories of ETFs. We have an innovative suite of financial sector ETFs designed by our experienced team of sector specialists. We're also one of the largest, actually we are the largest provider of enhanced ETFs that provide investors with enhanced growth and income from modest leverage of 25%. And then finally, a lot of our recent growth has come from our very popular suite of yield maximizer ETFs, which are really designed for income investors seeking higher levels of monthly income. So on that, on our yield maximizer ETFs, I should point out that over the course of the past year, you may have seen that we've expanded the suite out quite broadly. So it now includes virtually all major sectors in North America, as you can see on this slide. And the covered call space is, there's a lot of different options to choose from in Canada. So I think it's worth us spending about 1 minute on what makes us unique. So really how we approach covered call ETFs with our yield maximizer suite is we do what's called an income first approach, where we're tilting the dial more towards income over growth. Specifically, we're using at the money options, which fetch higher premiums than out of the money options. And we also have flexible coverage ratios because we still want to allow for some modest growth potential along the way as well. So where do these fit? This is a common question that comes up with a lot of advisors that we see across Canada. We generally like to position our yield maximizer ETFs as a small piece of the pie that can significantly increase your portfolio yield, even with a small allocation. So here on this slide, you'll see on the left side is a typical 60-40 portfolio, which would yield you about 2.7% right now. And then on the right side, we include a 10% weighting to HMAX, the Hamilton Canadian Financials Yield Maximizer ETF, has a target yield of 13%. So here you can see that just by adding a small sleeve, just a 10% allocation to HMAX or for any one of our Max Suite ETFs can significantly boost your portfolio yield here by about 1%. So as many as you know, though, we should point out that there's an inherent trade-off with covered call ETFs where you're trading off growth potential for higher yield. So the reason we show you this slide is really just to show you how just a small piece, a 10% allocation, can boost your yield, freeing up about 90% of your portfolio for other objectives, whether it's growth, capital preservation, or just diversification. So I'm going to go through two quick ideas before I hand things off to Rob. The first one I wanted to highlight is the fund we're quite proud of is the Hamilton US Midcap Financials ETF. It trades under the ticker HUM. So HUM, it's actively managed. It provides exposure to one of the best performing categories in the global financials over the past 20 years. Has material outperformance versus the large caps. And so here we in this slide, it's consistent with the outperformance. We wanted to show you HUM's performance. So not only is it the top performing US financials ETF in Canada with a 19% annualized rate of return since we launched it just over 3 years ago, it also has material outperformance versus US large cap banks, which we know are widely held amongst investors across Canada in their US portfolios. So our recommend allocation for a fund like this, like HUM, it's not to say that you shouldn't own large cap financials. I'm sure Ed will talk a little bit about the financials in his discussion today, but we do think it warrants having about a third of your portfolio in US. If you have a US financials portfolio, about a third of it should be allocated to the mid caps. as you get, not only you get diversification, you get higher growth, you get exposure to higher growth geographies, and you also get M&A potential. So on the next slide here, I wanted to just to show just a couple of timely things on this on the sector. Here you can see that the mid caps are trading 27% below their 10-year average PEs, while the large cap financials are actually trading at 11% above their 10-year average. So we're not saying you should shave off all your US large cap exposure, but it might be a compelling time to switch out some of your large cap exposure and look at something like HUM, and particularly if the rally broadens out beyond the large caps and if the economy continues to be to show some healthy performance. And then the final idea before we go to the Q&A, we wanted to introduce everyone to Canada's first covered call bond ETF. This is the Hamilton US Bond Yield Maximizer ETF. Provides exposure to trusted US Treasuries, has an active covered call strategy to increase monthly income. And really what this is, it's an interesting yield enhancement vehicle to consider for the fixed income side of your portfolio, as it not only provides a higher level of income than you get from other parts of your bond portfolio, but it does so in a tax efficient manner. As many of you know, it's capital gains treatment on premium income here in Canada. So you're getting a very nice attractive yield, but also tax efficiency. And importantly, you're doing that in an area of the market where you're not taking on additional credit risk because we're invested in US Treasuries. So I'm going to take you through two more slides. This slide here shows the MOVE index, which is basically shows levels of fixed income volatility, and the VIX, which many of you know shows equity volatility. So the chart here shows how bond market volatility was extremely low during the QE era, as the central banks were pumping billions into the bond market. However, in more normal environments, such as what we saw in 2003 and 2008, you can see periods where the bond market matches or even exceeds equity volatility. So our view is that it's unlikely that central banks are going to pursue QE on the same scale again. We do think it's likely that bond market volatility could remain at somewhat elevated levels. And so really what that does is it provides an ideal market for option strategies, such as what we have in H bond, because higher volatility basically equates to higher premium income potential as well. And then the very final slide, Ed, I know Ed will provide some thoughts on the US bond market, but the timing could also be quite good for a product like H bond. So as you can see by this slide, the US 10-year bonds were down significantly, not only in 2021, but also 2022 as rates were rising quite rapidly. So this is a rarity. It hasn't been down. The US 10-year has not been down 2 years in a row since the 1950s. And the magnitude is also quite significant to point out as well. So in 2022, the bond market experienced its largest drawdown in almost 100 years. So if you're of the view that the rate hiking cycle is largely over, this could be an opportune time to look at adding to your long duration fixed income exposure in something like H bond, where you'd get some upside potential, not all, because it is a covered call strategy, but you're also going to be getting a very nice, attractive, tax-efficient yield. So with that, I'm going to hand things over to Rob, who's going to start the Q&A with our distinguished guest. Over to you, Rob.
Yeah, thank you very much, Pat. So for those of you on the call, I wanted to thank you for your time and attention. I wanted to welcome Ed Yardeni. Ed really doesn't need any introduction, but I'll introduce him anyways. He's the president of Yardeni Research, of which we are a very happy client. Ed has been the chief investment strategist or chief economist for many prominent Wall Street firms over the past several decades before launching his own advisory firm. And Ed, as we all know, is a prominent Wall Street strategist and frequent contributor in the financial press. He wrote recently in the Financial Times a very interesting piece, which we're going to ask about. And he's a frequent guest on CNBC, including today, as a matter of fact. I also want to point out another distinguishing aspect of Ed, especially relative to his counterparts, is the sheer accuracy of his market forecasts. So if you're an investment advisor on the line right now, and I know all of the large banks have very good strategists and economists, but it's very hard to match the sheer accuracy of his forecasts. And in our opinion, it really is hard to imagine not going and getting a free trial of his service. And no, he did not ask us to say that, but I'm going to point that out anyway. So welcome, Ed. Thank you for joining.
Thank you for the kind words.
Yeah. So for those on the call, we're going to follow roughly the same format. We're going to talk about the the equity markets. We're going to talk about monetary policy, fiscal policy, and macro risks. But I'll just set the table here for a moment. So the general backdrop, which I like to describe every time we do a webcast with Ed. So the current environment, and Ed can correct me if I've missed something, is really characterized by the following. The U.S. market has been very strong, hitting highs, although not today, obviously. The Fed would appear to expect 3 rate reductions this year. The yield curve remains inverted. Inflation is clearly moderating, although there has not been a recession. You have expansionary fiscal policy, which is not sustainable. And I would say our own opinion would be that geopolitical risk remains high. So key background, if we wanted to start more generally, is the 10-year bond has risen about 100 basis points to 5% in September, October, in part because of looming Treasury auctions. This is the highest level in a decade. It's since fallen to about 4.4. Over that period, the markets have been strong, and the S&P 500 has benefited from multiple expansion. Unemployment remains low. So, Ed, one of the things that at the beginning of the year, you and others lay out your base case and your forecasts for what people should expect for the markets. The title of this webcast is this a return to the Roaring '20s? Wanted to take you to your base case, which you have assigned a 60% probability. At the beginning of the year, you said this could be akin to the Roaring '20s. Did you want to describe what you meant by that?
Yeah, well, actually, since 2020, we've been saying that there's some rhyming going on between the 1920s and the 2020s. Might there be also the economies be similar in some ways? And I think the answer is probably so. We did have some very good grounds for pessimism at the beginning of the 1920s. A couple of years before that was World War, the Great War, as they call it, because they didn't know there was a Second World War coming. There was a Spanish flu pandemic that killed millions. And then there was a depression in the United States in 1920. In 1920, they call it depression. They hadn't used the word recession at that point. So it had to be awfully pessimistic environment, and yet it turned out to be the roaring 1920s because of technological innovation, boosting productivity, and tremendously increasing the standard of living. The stock market had a great rally, obviously came to an end in 1929, 1930, but the decade itself was one of a great prosperity. We look at the current situation, and just, a few years ago, we were in the midst of a terrible global pandemic. We have seen that there's been a lot of pessimism about potential recession. It's probably the most widely anticipated recession ever that has yet to show up. But nevertheless, pessimism was quite thick over the past couple of years, and the stock market had a bear market in 2022. And yet suddenly on October 12th of 2022, the market made a bottom, and we've seen the market not going straight up, but it went up straight up. It went straight up until August of last year, had a traditional 10% correction. And then it's up again to all-time record highs. And for all the concerns that it was narrow, it's actually been a fairly broad bull market. It's just some stocks are up 50% or more, making other stocks that are up only a piddling 20% look relatively weak by comparison. But it's been actually a great bull market. And I think the bull market started to discount our roaring 2020 scenario. I know exactly when, November 30th, 2022. So, just a few weeks after the bottom on October 12th, the market started to discount artificial intelligence as being a great booster to productivity. And we all know that productivity is sort of the fairy dust of the economy. If it's growing fast enough, it's a great booster of economic growth, real GDP. It is great at keeping inflation down because it keeps a lid on unit labor costs. It allows wages to rise faster than prices, and it's great for profit margins. So it's a win-win-win-win situation when we're talking about productivity growing faster than expected. Last year, productivity grew faster than expected. And I'm anticipating that it'll continue to grow rapidly. So I think we're in a sort of the mid stages of a big productivity growth boom. And if that's the case, and economic growth could be better than expected, with inflation lower than expected, and continuing widespread prosperity. There's a lot of pessimists out there who claim that American standard of living has stagnated for decades, that the average American is doing very poorly. But if you look at inflation-adjusted consumption per household, it's at an all-time record high, and I think that's a pretty good measure for the standard of living. I mean, the rich can only eat so much and buy so much in terms of property and cars and things like that. So I don't think they really skew that indicator very much. And the reality is, in the United States, the trend line for consumption per household, real consumption per household, has been 1.8% per year, which means that the standard of living doubles every 40 years, which is exactly what it's done over the past 40 years. Now, the risk to the 2020 scenario, which I guess we'll discuss shortly, is something like the 1970s.
Hold that thought. Hold that thought, because
sure.
I'm gonna come to that one. But
okay,
while we're on the Roaring '20s, to the extent that, as you mentioned, there's kind of a technology-led driving higher productivity, growth in real GDP, real wages, and so on. That's good for the stock market. What do you think that means for the bond market?
Well, I think it means that the bond yield should probably remain around this level. 4.5% is a bond yield that was normal before the great financial crisis. The abnormality in the financial markets really was between the great financial crisis and the great virus crisis, when central bankers had this obsession about getting inflation up to 2%. Remember, those are the good old days.
Yeah.
It took a pandemic and excessive stimulus, fiscal and monetary stimulus, and supply chain disruptions. All those things and other things came together, like Russia invading the Ukraine. All those things came together and created an inflation problem. But I didn't think that the inflation would be persistent. I thought it might be transitory. It's turned out to be very transitory in terms of goods, as supply chain disruptions passed behind us. We did see that goods inflation has come down. Meanwhile, China's been in a significant recession, and they continue to export deflation to the rest of the world. Services inflation is coming down, but put it all together for the bond market. The bond market historically hasn't really been focused on supply and demand. I think that's because the supply issue becomes an issue during recessions, but then it's a non-issue, because we all know that during recessions, when the supply of treasuries increase, as the deficit increases, short-term rates are coming down and inflation's coming down. So supply really hasn't been an issue. What's different this time is we've seen this huge deficits and accumulating debt in a period of economic growth. And so that's the bearish outlook for the bond market. But I think, I doubt that we're going to get back up to 5% anytime soon. I think this level is an appropriate level in a world where productivity is likely to keep inflation down. But it also means that the economy can withstand these levels of interest rates. And we can discuss that more when we get into the Fed.
So and I'm going to ask you about fiscal policy near the end, but
sure.
Your second scenario for the markets, which you've assigned a 20% probability, is something more akin to the 1990s. So did you want to describe that scenario briefly?
Well, it's actually another happy scenario that ends unhappily. The 1990s was also kind of like the 1920s. It was a period where productivity growth was very strong, particularly in the second half of the decade. Inflation was very, very moderate. Economic growth was very strong. Politically, we had a Democrat in at least in the first part of the decade with Clinton, but a Democrat who was very much attuned to the risk of the bond vigilantes acting up if the deficits were too large. So he was actually the government ran a fairly conservative fiscal policy during the 1990s, just the way in the 1920s we had two Republican presidents who basically were very laissez-faire in their orientation. But then, of course, the internet came along, and people started to get very excited about that technology, and there were lots of companies that provided the infrastructure for that technology, like Cisco and other telecommunications companies. And then, of course, there was all the speculative stuff, the dot-coms that raised a lot of money and bought a lot of the equipment to be able to access the internet. But once their first round of financing was over, once they burned through it all, they weren't able to attract more funds, and that kind of set the stage for a collapse in the tech bubble and became known as the tech wreck.
Right.
So my concern is that if the Fed prematurely lowers interest rates, I did not understand this notion earlier in the year. The market's expecting so many rate cuts. It seemed to me the economy was strong and inflation was moderating. So why should the Fed lower interest rates? And so I think what we're seeing is that the economy can handle these levels of interest rates.
But in this scenario, you had mentioned in your writings that the Fed becomes concerned about inflation falling and they start cutting rates. That leads to a melt up in the markets. And then, as you alluded to, it ends badly because the bubble has to burst. Is it fair to say, so that's a bullish scenario for stocks as well, at least
short term
in the first part. Is it fair to say that that scenario is more bullish for the bond market because at least for a period rates are falling?
Well, I think for the bond market still, I think, is increasingly sensitive to supply and demand as it was from August to the end of October of last year. So I think the supply issue is still there, but it's still being overtaken by the inflation and Fed situations. The bond market historically has been a function of where are short-term rates, where are they expected to go, and of course that relates to expectations of what the Fed is going to be doing. And if the perception is that the Fed's going to be tightening, then obviously the bond yield goes up, maybe not as fast as short-term rates at some point, which is when you get the inversions. But the reality is that the bond market could do well in a 1990 scenario if the reason that the Fed is lowering interest rates is because they are concerned that the economy is weakening. But I can't see any justification for that right here.
So
the 1990 scenario is more a concern that if the Fed talks and acts too dovishly, they'll get a melt up in the stock market, which will set it up for a meltdown in the stock market.
So we have two bullish scenarios, the 20s, the 90s, and then you also laid out a third scenario, which is the bearish scenario, which is maybe this isn't the 20s, maybe it's not the 90s, maybe it's unfortunately more like the 1970s, which you've assigned a 20% probability to, or maybe it's just a plain old recession. Did you want to talk about what would happen for this to be like a 1970s like scenario, God forbid?
Well, it's not that hard to imagine what could happen. It goes back to your concerns, my concerns about the geopolitical risk. Things are not getting any better, and the war not getting any closer to peace, negotiations, or anything to cool the situation down between Russia and Ukraine. As a matter of fact, it looks like it's heating up again. However, the world seems to have figured out how to live with that. Grain prices have come down, oil prices have come down, but we had a lot of fear during the first energy shock of the 2020s, and that energy shock occurred when Russia invaded Ukraine, and that was early 2022. If we get a second energy shock, that would be very reminiscent of what happened in the 1970s. And, when Hamas attacked Israel on October 7th of 2023, the price of oil actually kept going down. It was really quite remarkable. And I think that's because the global economy was looking weak, and there was supply, and the Saudis and the Russians had to cut their production some more just to keep the prices from falling. But now, since late last year, we've seen the price of oil starting to move up. It's possible that the supply cutbacks by the Saudis and the Russians are having some impact. I think it's also very possible that the market is starting to include the oil market, the oil price is starting to include a geopolitical risk premium for the war between Israel and Hamas to spread to the entire region. We saw just yesterday news that Israel bombed the consulate, embassy, actually, I think it is in Syria, of the Iranians, and took out some Iranian leadership, I think, on their military wing. So there's certainly a risk here that at some point there will be a confrontation between Iran and Iraq that might have, and Iran, I should say, and might have some impact on the supply of oil. In which case, if we started to see oil spike up to 100, which isn't that far anymore, we're getting pretty close to 90 for Brent crude oil, we could have another energy-led wage price spiral. And then the Fed, of course, wouldn't be lowering interest rates at all. They might actually be raising interest rates again. And that would be a bad scenario for the U.S. economy, the global economy, the outlook for global inflation, and of course, stocks and bonds would do miserably.
So, those three scenarios are all very interesting, but it almost seems that, at least as it relates to the last, call it 4 months, you've almost been too right, which is your constructive stance maybe didn't quite anticipate the sheer size of the rally or the move. So here we are today, and the forward PE of the S&P 500 is approximately 20. The last time we spoke to you was in November, it was 17. So there's been a lot of multiple expansion. Right. So I know you were on CNBC today talking about you'd like to see more of an earnings-led, the market getting driven by earnings. Right. Do you see any risks like that maybe doesn't happen, or why it might not happen, or that some of this multiple expansion unwinds?
Well, I think to the extent that the financial markets give up on the idea that the Fed's going to be lowering interest rates much or at all this year, that might keep the valuation multiple from rising. The latest forward PE is actually at 21 already, which is not that far off from the peak we had during the tech bubble when we got to 25. Arguably, the valuation multiple is higher here because companies like NVIDIA that people want to own and are paying a high valuation multiple because they are delivering growth. But as we're seeing recently, the Magnificent Seven, not all of them are that magnificent anymore. Right. Tesla has obviously had some issues, and then a few of the companies are being sued by the Justice Department for monopoly practices, anti-competitive practices. So it's exactly right. I mean, I'd like to see the market go up with earnings with less valuation drive. Valuation always drives us in the initial phases of a bull market, and then at some point along the way, earnings take over. And I think we're kind of at that point, but that probably means that it's not going to go straight up the way it has been. Look, at the beginning, early at the end of last year, I was talking about 5,400 on the S&P 500 by the end of this year, and I was the highest among the strategists polled by Bloomberg and others. Last week I thought we might get there by the end of this week or the middle of this week. I guess it's still possible, but I'm rooting for this thing to kind of settle down and for it to become more of a stock picker's market focusing on earnings. But market doesn't usually deliver what we want. We'll see how it plays out. But I think if the market concludes that it's not a bad trade to have a stronger economy without the Fed lowering interest rates, and then you focus on earnings.
Okay, so so that's all very helpful. I thought we would segue to monetary policy because there's a lot going on. I'm not going to talk about the things that we've asked about in the past, like quantitative tightening and that. But one of the things I thought was very interesting that you've written about, and I think it was it this past Monday in the Financial Times? It was very recently.
Yeah.
So the yield curve has been inverted. So
Last week.
last week. So there's no question the yield curve has been inverted for quite a while. So the 10 years at 4.25, the Fed funds rate is 5.3. So the 2-year to the 10-year is negative 35 basis points. The 2-year to the Fed funds rate is minus 95. It's actually been inverted for nearly 2 years, despite rising inflation not causing recession. So you had this opinion piece in the Financial Times about monetary policy that maybe the efficacy of the yield curve forecasting a recession might not be as relevant as it used to be. And I don't want to give away the ending of the movie, but do you want to discuss why you think that the yield curve might not have the same predictive quality as it's had in the past?
Well, in 2019, I wrote a short study that's available on Amazon. It's also available to our subscribers on understanding the yield curve. And we studied it, and particularly the notion that inverted yield curves are great predictors of recessions, which they have been indeed. However, we concluded that yield curves don't cause recessions, for starters. Some people actually believe it causes recessions. And what yield curves really do is they predict a process that in the past has led to a recession. So what happens is, why would anybody in their right mind buy a 10-year bond at 4.5% when they could get a 2-year note at 5%? Well, the answer is because they think that that the short-term rates are too high and something is going to break, and they don't know exactly when rates are peaking, but 4.5% looks pretty good. And they, if you buy it at 4.5%, then you're actually rooting for the Fed keep going, keep raising rates until something breaks, because then you're going to have to lower rates dramatically. So what inverted yield curves really predict is that if the Fed keeps raising rates, then something will break. There'll be a financial crisis, and that financial crisis then will probably morph into a credit crunch, which means an economy-wide shortage of credit, even to good borrowers. And that's what causes recessions. It's credit crunches that cause recessions. There are other causes like spiking energy prices, which gets us back to the 1970 scenario. But I've shown a chart showing the inverted yield curve, showing the Fed funds rate. The Fed funds rate typically peaks when something breaks. Then the Fed said, "Oh my God, we went too far. Now we're going to have to ease." People look and say, "Well, they don't pause for very long before they have to ease." Well, that's all because tight monetary policy in the past has been kind of signaled with inverted yield curve as getting into very restrictive territory. And this time around, what happened is the yield curve was dead on right. It got the financial crisis right. That happened March of last year. It was a banking crisis that occurred on March 10th, on a Friday. On March 12th, the Fed came up with a new emergency liquidity facility and completely stabilize the situation. The Fed, since the great financial crisis, has a lot of practice playing whack-a-mole, that arcade game when the moles pop up and you hammer it. So that's what they do with these emergency liquidity facilities. So you have to factor in that maybe they've gotten good at avoiding financial crises becoming credit crunches. And if that's the case, then you don't get recessions. It doesn't mean that it'll never be a recession again, but it's something you have to factor in of why the yield curve might not be right this time because of that liquidity facility. So that's the way I'm looking at it. It is still puzzling, I guess, that it's still inverted right now.
Right.
But I guess it is an indication that there's some people who believe that the Fed is going to have to lower interest rates dramatically because something will break. They believe in that monetary policy operates on the economy with a long and variable lag. And in my Financial Times piece, I said, well, maybe we should, who says? Where's that been proven? I mean, Milton Friedman is the one who said it, and he won a Nobel Prize, so he should know, I guess. But I don't think it's ever been proven that there's any particular reason why monetary policy operates with a long and variable lag. Tight monetary policy operates until something breaks in the financial system. Then you get a credit crunch, then you get a recession, and the Fed lowers interest rates dramatically, and there's no long-term effects. I will grant you that the commercial real estate market is going to be kind of a long-winded downturn as a result of a tight monetary policy, but I don't think it's going to take the overall economy down.
So it disinverts by the Fed funds rate falling. And so do you think, I know your rule of thumb, which seems to work quite well, is the 2 years, what the market thinks the Fed funds rate is going to be a year out. So the Fed funds rate is, call it 5.3, give or take. I guess your view is maybe the 10-year stays at 4 maybe it settles in at 4.5 to 5, and that's right now it's lower than that, and that the Fed funds rate basically falls to 3 or 3.5, and that process takes place over a multi-year period.
Yeah, in the 1970s scenario, what happens, of course, is the bond yield goes higher because all hopes of the Fed ever easing again kind of disappear, and it's the spike in energy prices that cause the recession, and then that's when the Fed starts to ease, and that's when the bonds do better. So, I mean, will we ever see 5% again? It's conceivable in a 1970s kind of scenario, and it may be, once again, a great buying opportunity that lasts a nanosecond that you got to just jump on.
Right.
Other than that, if you're not great at trading these things, you could always have some liquidity on the side and be opportunistic.
So, which brings us to the next topic is fiscal policy. So I think I went through my notes, and like the last 5 webcasts, I've mentioned deficits and debt, and maybe a not very competent political class, which seems to be making things worse. But you were on CNBC today, and it's funny, you answered the question on CNBC that I was going to ask you on this webcast is, I think, it's quite concerning that fiscal policy is unsustainable. It's kind of a slow-moving build in macro risk where rising interest costs just eat up more and more of the budget until you get some sort of painful fiscal consolidation, which may or may not be triggered by the bond market, which brings me to, at what point, and I know you answered it on CNBC this morning, but at what point do you start to worry about the consequences of unsustainable fiscal policy, which obviously are pretty bad in Canada, but they're pretty bad in the United States too? When does it become a problem for the market?
Well, I think we got a glimpse of that back in August, September, October of last year. It becomes a problem, and it becomes a problem in the sense that, back then there was some jitters that, maybe the Fed's not going to ease, maybe inflation is not coming down as much as expected. And so the backdrop for the bonds wasn't all that wonderful. And then, of course, we had this huge announcement of third quarter financings by the Treasury. And so, people like Bill Ackman, made a list of all the things that were bearish for bonds, and supply was on that list. And he did very well. He traded to 5%, and then he said, that's good enough. So that's the problem with this problem. It's you never really know when the markets are going to care about it, and it's conceivable that it's we're starting to see that kind of issue pop up, and we're not. And what will make us realize it, of course, is when we have a really bad auction, and and that could be a combination of the markets giving up on the Fed lowering rates, and concluding that people have pulled back from buying these bonds, even though the yields have actually gone up and they're more attractive.
Do you think it's fair to say that? Oh, sorry. Do you think it's fair to say that as long as the U.S. is producing, very robust GDP and also productivity gains, that's essentially extending the timeline of any sort of reckoning? Or
that's my story. Yeah, that's what I believe. I mean, that's part of the roaring 2020 scenarios, that if you get better than expected economic growth, and the debt to GDP ratio doesn't rises rapidly, and better than in that scenario, inflation comes down, and it does give the Fed some wiggle room. They could lower interest rates without any dire consequences. The only thing that worries me about lower interest rates is the speculative bubbles in the assets market. Inflation
Right.
is, as we all know, is not just a matter of consumer price index. It's also a matter of stock market, Bitcoin, gold, and all these other kind of assets. So I'd hate to see the Fed, win on the price inflation side, only to create a speculative bubble that
Right.
either they have to burst for one reason or another, or it kind of bursts on its own. So we live at interesting times, to
Yeah.
say the least.
Now, I know you don't follow Canada, nor do you need to, or even would it even be interesting? But one of the challenges we have here is productivity is abysmal. And so we have the worst of both worlds, which is unsustainable fiscal policy, mediocre GDP growth, and terrible productivity. And the United States has one of those three. We have three of those three.
Right.
So I know you mentioned, I think, just to sum up that question, I think you had mentioned you'll worry about this when the bond vigilantes start to worry.
Yeah.
Yeah, and so which takes us to, because we got about 15 minutes more, which let's talk about geopolitics and macro risks without talking about politics, geopolitics and macro risks. The last time we talked about Russia, which has not gone away, you've written more about it. If we had to go through the list of worries that you might have, I know we alluded to an oil shock in the Middle East. Is there anything that you think people should have on their mind with respect to China, as an example, or some other part of the world?
Well, the geopolitical risks are the obvious ones, clearly Russia, Ukraine, and Israel, Gaza, Middle East, Iran, and that mess. And then, of course, as you point out, China, Taiwan issue. I think of those three, we may have lucked out here and seen that China's economy is performing so poorly that the odds that they will attack Taiwan anytime soon have been significantly reduced. For a while there, the rhetoric looked like they were getting set to invade soon. But then I think they started to realize that this property bubble that's burst, that's created basically a property depression in their country, is going to weigh on their economy for a long time. We've had similar experiences with property bubbles in Japan and in the United States. And it took 5 to 7 years to kind of restructure things and to overcome the deflationary consequences of having such a significant negative wealth effect on the consumer. The Chinese consumer has been beat up not just with a negative wealth effect from property that they own as assets, but also from their stock market, which has been down significantly.
Now,
and the government's I mean, so I think what I think is the Chinese government is doing now is they're kind of giving up on stimulating the consumer. They kind of screwed up the consumer big time with the one-child policy that now means that China has the world's largest nursing home.
Right. Now, it's interesting because when there was a property bubble bursting in the United States in the global financial crisis, they learned from Japan, because when the property bubble burst in Japan, they did not recapitalize the banks. So they stayed as zombie banks pretty much for almost 2 decades, which was intensely deflationary. Whereas the Americans, I think, if I recall, specifically learned from that, explicitly identified that as an issue, and recapitalized the banks, which allowed the financial system to resume and the banks to continue lending and allow for an economic recovery, which never happened in Japan, or at least almost took, a generation, basically. So in China, with this property bubble bursting, and I know it's because they're not a developed economy and they don't really follow GAAP, it's hard to tell. Do you feel that one of the things that they really are going to need to do is recapitalize their banking sector in order to try to deal with some of these issues? Or do you think we'll just never know and SOEs will just end up, doing a restructuring of the economy without anybody seeing it?
Yeah, I don't know. I think the Chinese government and regulators do study what happens and has happened in other parts of the world. So it's conceivable that they will act more aggressively in recapitalizing their banks, which I guess means creating some banks where the bad assets are kept. But the Chinese, unlike the United States, don't have a a very important industry, which is a distressed assets industry. Now, we had that savings and loan debacle in the late 80s, early 90s.
Right.
And the government came up with a brilliant solution, which was the Resolution Trust
That's right.
Corporation. That's when we realized that if you got a huge problem like that, you got to really restructure it quickly. You can't just let it fester. And so there were some huge hits taken, but some amazing values provided from the use of the Resolution Trust Corporation. And Wall Street learned from that and said, this is a pretty profitable business. If you can buy good assets at 25 cents on the dollar and have the cash to turn them around, that's a great business. All you got to do is wait around for these things to happen from time to time. So I don't think the Chinese have a distressed asset business. I mean, nobody's going to want to go in and buy all these ghost cities apartments.
In fact, it's the opposite. Their banks are huge.
Yeah.
And they have a concentrated banking system, which makes this problem even worse.
Yeah. So I don't know how easy it's going to be to recapitalize the banks when I don't see the other side of the trade. I mean, it's one thing to put something for sale at 25 cents a dollar just to clear the deck. But if nobody steps up, then you still haven't recapitalized.
I guess I just wonder if this problem just persists in part because of that, which actually takes, I know Pat, my partner Pat at the beginning talked about our US mid-cap financials ETF, where you can see, to your point, where the government dealt relatively very quickly with the issue of liquidity facilities. So you have the US regional banks and the US mid-cap banks, which are still quite healthy in aggregate, but still trade at very distressed valuation, or not distressed, but very, very deep discounts, in our opinion, creating a fairly significant opportunity. Is there anything else? I mean, Russia, I guess I don't want to talk, I never want to talk about politics, at least in specifics, but the US does have an election in November. The last time, I guess, do you worry about anything related to the election in terms of what it might do stock market? And
well, I do worry about the domestic politics quite a bit, but it's such a mess that I don't know what to write about it other than it's such a mess. And what more can I say than we've got the two oldest and most divisive presidential candidates ever. One is hated by half the population, and the other is hated by the other half of the population. And we've become increasingly partisan. Some of that partisanship has been seen as violence. And so I do worry about that quite a bit, and a lot of dislocations. But if you study American history, what you find is Americans have never really gotten along. We've always been at each other's throats. I mean, the most obvious example, of course, is the Civil War. But politics has always been dirty, as it is in most places, I guess. And yet, look how well the U.S. economy has done, and continues to do. I think what's important to realize is that there are millions of people, a few 100 million of people, that go to work every day here, and of course in Canada and other places, where we're just too busy to pay much attention to politics, which is why it gets uglier and uglier, because good, hardworking people don't have a lot of time to deal with that sordid part of the economy. And the good folks just spend all day trying to make their businesses and do their work better for themselves, their families, their country. And so far, we've managed to overwhelm the negative consequences of Washington and other capitals around the world.
So basically, I know it's completely unpredictable, but very, very tough political environment. But the election itself, it's hard. It probably doesn't represent a risk to the markets.
Well, I mean, it depends. I mean, it does. I mean, if it's 50-50, both sides scream that it's stolen, that's a risk. But we had something like that with Bush and Gore, and I think it was 250 Chads in Florida that decided the election, and we moved on. It helped that Gore conceded,
Yes.
But imagine if we have two candidates that refuse to concede. So yeah, you could come up with some pretty ugly scenarios. But I think what we've learned as investors is that both domestic and geopolitics crises tend to be buying opportunities.
Right.
One way or another, we get through them. Unless we're talking about, civil war in the United States or World War II, if those are not the outcomes of all these ugly things going around the world, then I would view these crises as buying opportunities. And we saw that in 2022 when the market sold off on Russia invading Ukraine and what that did to the price of oil. It didn't take long for the market to bottom. It topped on January 3rd, 2022, and it was a roaring buy on October 12th of 2022.
And so, last couple questions because we have 5 minutes to go on equities. In the past webcasts, you have accurately expressed your preference towards domestic or U.S. equities. Is that still your preference? I know our portfolio manager, Rob Webb, has been talking a little bit more about Europe and our global financials ETF, adding some European exposure. Europe seems to be doing a little bit better of late. Do you have any comments about geography?
Yeah, I would continue to overweight the United States. That doesn't mean only invest in the United States. There's certainly opportunities. I mean, the Japanese market has done extremely well. The European markets have done remarkably well, given that their economy just doesn't look all that wonderful. I mean, it's really somewhat puzzling that as muddled as the global economy and political situation looks, stocks have actually done pretty well around the world. My preference is still the U.S. We have one advantage over a lot of other countries in terms of having a big technology and communication services sectors, and those do very well in my roaring 2020 scenario, and therefore, to the extent that other countries don't have something like them in their indexes, they underperform. I mean, historically, the rest of the world is traded like the S&P 500 value sector. And maybe that's because there's a lot of energy and financials overseas relative to technology. So I have no problems, finding opportunities in financial energy, some other areas, maybe even occasionally some technology. But overall, I would overweight the U.S. I think, we still have the largest economy in the world. We still have really cheap energy. Natural gas prices have come down dramatically. We have a real shortage of labor, but so does everybody else. The way things are going at the southern border, we might have less of a shortage.
Right.
And I mean, the positive side of immigration is it's always been a booster of economic growth, unless all these folks are just coming into the welfare system instead of going to work. But if most of them go to work, that will actually be a positive. I know Canada has a lot of immigration because you too have labor shortages, and hardworking immigrants should be welcomed. They do make it better for everybody. So all in all, I think the U.S. Still merits being overweighted, even though the valuation multiple reflects that.
And very last question, which I always end with: large caps versus mid caps.
Both. I mean, there was a lot of talk about this being a very narrow bull market, that it was just a handful of stocks, the Magnificent Seven, so-called. And meanwhile, people were missing a lot of opportunities in mid-cap industrials, mid-cap financials, mid-cap energy now. I would, the MSCI indexes combine the large caps and the mid caps. So that's kind of the way I like to view it. I think the mid caps do have some, do tend to grow faster than large caps, though nothing is true forever. We've seen large caps earnings, especially among the Magnificent Seven, grow faster than anybody else. The small caps, one of the structural problems in the small cap market now is the really good companies get swept up, get bought before they come to market by
Right.
the larger cap companies with a lot of cash and that want to be invested in certain technologies or parts of the economy. So that kind of raises the question of, well, so if all the good stuff, the whole point of buying something small is so it becomes large.
Right.
But if quality small stuff gets taken out before you even have a chance to buy it, or even if they come to market and you have a chance to buy it, and then they get swooped up anyways before they can become mid cap and large cap, it's kind of frustrating.
Yeah. And so, well, thank you very much. So I just want to direct the audience and recommend they go to quicktakes@yardeni.com, YARDENI.com. And as we've said before, we're a very happy client of Ed's research, and we would strongly recommend it. So, and on behalf of the very large audience that we have, Ed, I just wanted to thank you for your time speaking to us.
Thank you, Rob.
Okay. Have a great day.
Thank you, everybody.